Hi, welcome to the USD Nonprofit Governance Symposium 2021. Today we're going to talk about best practices in executive compensation for nonprofit organizations. Keys to attract, retain, and reward your best talent. I'm Corey Grant.
And I'm David Jacobs, and we're partners at the firm Grant, Hinkle & Jacobs.
So today we're going to talk about key issues in non-qualified deferred compensation. The first thing we need to understand is a little bit of background and how the Secure Act affects nonprofits and their executives. So the Secure Act had a little-known provision in it that applied to nonprofit compensation. And what it did was it really leveled the playing field between the nonprofit and the for-profit world. So excise taxes are due for the organization if an executive is compensated more than a certain amount in any given year. And that total compensation includes cash and other benefits. So this excise tax could affect current employees, also employees separating from service with large 457F or other deferred compensation balance. So, as I said, the law was made to correlate nonprofit and the for-profit world. So with that being said, we have to understand what the triggers are. We have executives with more than $1 million in current compensation, and that's not too common in the nonprofit world. But if we have executives with less than $1 million in compensation, but expect to receive a distribution from a plan, that can trigger the excise tax, and that can put your nonprofit in peril. The excise tax, 21%, is levied on the nonprofit, and I can tell you that that is not going to look good on your 990. So let's talk about the nonprofit executive compensation considerations. You want to look at designing your plan. You want to look at the executive's age, their stage, how many years they have till retirement, and what this is going to look like when you design their compensation program. How's it going to look on the 990? What's it going to look like in the community? So those are considerations, little background on the Secure Act, considerations that every nonprofit should consider. So, David, let's talk about the importance of retaining key people.
Thanks, Corey. You know, that's why we really are here today, is to really talk about how important your key people are and how important it is to attract and reward and retain those key people, especially once you've found somebody who's really going to be valuable for your organization. And there have been a lot of studies both on the nonprofit and on the for-profit side when it comes to executive retention. I'm not going to go over all of these study results with you, but a couple that I wanted to highlight was that the study by the American Center for Progress found that it takes about 213% of an executive's salaries to replace that executive. So if you have an executive making $100,000 a year, it costs about $213,000 to replace that key executive. That's a big number and something that organizations really need to take into account, especially when you consider that turnover is not just, finding somebody to replace that key executive. There are interviews, there are competitors, there are training people underneath that new leader who will respect and respond to that new leader. There are other people in the organization who may be upset that the former leader is not there anymore, and there may be impacts on that level. So turnover is really a key issue that nonprofits need to really focus on. And one of the interesting studies that we rely upon a lot is in the for-profit world. Everybody's familiar with Vistage, and it's interesting that a recent survey that Vistage conducted found that 93% of businesses are currently in a hiring mode, whether or not that's planning to expand the existing workforce or planning to replace people that are going to leave. That's a really big number. And that means that employees are out there looking for opportunities and employers are out there looking to offer opportunities. One last bit of data that I wanted to share was the difference between nonprofits and for-profits when it comes to retention planning. It's interesting that nonprofits have a voluntary annual turnover rate of 19%, whereas the for-profit industries have a 12% voluntary turnover rate. Why is that? Is it because for-profit organizations can offer equity, possibly, as an incentive, and nonprofit organizations can't? We'll get into some of those differences a little bit later. Another highlight that I wanted to mention is that 45% of those in the nonprofit space say that they're going to be seeking a new job within the next 5 years. And a quarter of those people said they're not intending to stay in the nonprofit world. So again, in this environment where we can interview on Zoom, where there are nonprofit and for-profit employers actively recruiting, it's really key to focus on retaining those people that are most valuable to your organization.
So let's talk about non-qualified CERP funding strategies for nonprofit organizations. Nonprofit executive funding alternatives are a little different than the for-profit world. In the for-profit world, we have IRAs, SEPs, simple plans, 401ks, etc. In the nonprofit world, we have a little bit of a different menu, if you will. We have executive bonus plans. We have 457F, Section 457F, traditional or insured plans. We also have a creative alternative called split dollar that we'll talk about a little bit later that can either be done on a cash flow basis or it can be financed. So lots of different alternatives in the nonprofit world. So how do you determine which program or which strategy is best for your organization? So here's a partial list of the things that we go through with each of our clients. First, we determine the type of desired vesting. Do you want the vesting for this employee benefit to occur gradually over a period of years, or do you want it to be a cliff vesting, where it's vesting at the end of 5 or 10 or 15 years, whatever it may be? The second thing is, once you've determined the vesting, we determine what type of plan to use. Do we use an executive bonus plan? Do we use a 457? Or do we use a split dollar? In our practice, what we will do is sit down with each of the nonprofit's executives, typically someone from the investment committee, the CFO, and any other interested parties, and we'll go through an analysis and model through each of these alternatives so you can actually see which one is best for you. The third issue that we address is, how do you fund this? Do you fund it with securities, or do you fund it with a life insurance-based program? The fourth thing, we implement and then review annually. It's really important to review these programs annually to determine if the funding is adequate. You don't want to get into a situation where 5, 10 years down the road you haven't reviewed the plan and you end up with a underfunded plan. So, Dave, let's talk a little bit about the benefits of using life insurance.
Thanks, Corey. Yeah, you mentioned that life insurance and securities are both typically used as funding vehicles for these types of arrangements. So let's talk a little bit about the benefits of using life insurance, because it is a unique asset, especially when designed in this fashion. So particularly when designing supplemental executive retirement plans for nonprofits, it's really critical that both the key employee has a benefit, but also the sponsoring organization receives a benefit as well. And that's why life insurance is the most typically used asset class to fund CERPs. In fact, 86% of the top 50 banks use life insurance to fund their CERP plans, as well as 75% of the Fortune 1000 companies. And they use it for 3 reasons. First of all, just to provide context, we're talking about permanent life insurance policies. These are insurance contracts that aren't term insurance. They're permanent in nature, meaning they're designed to last for a lifetime, and they include a cash value component that can be used while the insured is alive. So the reason why these organizations in the for-profit world use so much life insurance in their SERPs is because the growth of the cash value component is very predictable and it's competitive. And there are a lot of choices and buckets in which you can choose as far as a growth mechanism for the cash value. There's also a death benefit, a life insurance component to the contract, and that protects the nonprofit organization in case that key executive passes away unexpectedly prior to retirement. And third, life insurance policies are liquid. So just in case the organization or the key employee has a change of heart, there are exit strategies, which are critical in the life insurance space. We also want to make sure that that these assets are not subject to market fluctuations. And so having life insurance as a stability mechanism, not something that is exposed to the market, is something that adds additional stability, and another reason why these organizations are so comfortable using it as a funding mechanism. So let's talk about the first type of supplemental executive retirement plan that Corey mentioned, and that's the executive bonus plan. There are a couple of different flavors of executive bonus plans. The most basic form of an executive bonus is that the organization bonuses an amount of money to their key employee that's large enough for the key employee to purchase a permanent life insurance policy on their life. Easy enough. However, when there's a bonus made to that key employee, there is an income tax that's due. So the double bonus arrangement allows the organization to not only bonus the key executive the amount that he or she needs for the premium, but also to pay the income tax on that bonus. So there really is no out-of-pocket expense for the key executive. And the third type of bonus plan is called a restricted bonus plan. And this is a little bit about what Corey was referring to as far as vesting and cliff schedules, because the restricted bonus plan is really more of a golden handcuff. It doesn't allow the executive to receive any of the bonuses until he or she performs to metrics that you and the nonprofit and you and the key executive negotiate beforehand. It could be performance metrics. It could be length of time metrics. The nice thing is it's customizable for both the organization and the key executive. But the key is that even though the executive is bonused these amounts for premium over time, they're not allowed to access the benefits until they've achieved this metric that's been agreed upon. So that really provides an incentive mechanism for the organization to say to their key person, you can stay here. We'd really like you to stay here and we'd like you to perform. And if you do, there's going to be a reward for you at the end of the day. $457F arrangements are another option that a nonprofit has to incentivize its key employees. Corey, I'm going to turn it over to you, and maybe you can talk a little bit about 457F plans.
Thank you, David. So let's talk a little bit about Section 457F and the non-qualified deferred compensation arrangements under that code section. So it's a 457 plan is a written agreement between the organization and an eligible employee to pay benefits when they separate from service or die or become disabled. They're allowed to defer amounts of earnings and employer assets, and they have to be subject to the claim of general creditors. There has to be a real risk of forfeiture in order for the amounts to be deferred. Well, who's a creditor of a nonprofit organization? You know, not really an issue to be concerned about. So the most important thing with a 457 is there's really no limit on the amount that can be deferred. So if an individual wants to defer a lot of money, they can do so, and the organization can really provide for that individual within these type of programs on a discriminatory basis. So let's take a look at the traditional 457F. Typically, you'll have an organization that funds a SERP, a supplemental executive retirement plan, with taxable securities. At vesting or retirement, there's a distribution to the executive, a big income tax paid at that point, and then the executive is left with taxable securities. So that's a great, from an executive standpoint, they say, hey, great, I have money I didn't have. But they've paid tax not only when they rolled the money out of the plan, but on ongoing earnings from the assets distributed from the plan. So it's not like they can roll it over into an IRA. They're stuck with a taxable account. So let's look at insured 457 as an alternative. The same structure applies. It's a SERP funded with life insurance instead of securities, distribution, income tax paid, same income tax paid on vesting. However, once the individual executive pays the tax on the distribution, there are no more taxes on the earnings on a go-forward basis. That's because Code Section 7702 says that distributions from life insurance contracts that are treated as loans are not taxed to the individual. So the executive has a much more favorable situation from a tax perspective after they retire. From the organization standpoint, it's like, hey, I gave the guy or gal, a SERP that's funded. It doesn't matter to us. We're a nonprofit. But the executive is still a taxpayer. Whether you work for a nonprofit or a for-profit, you as an individual are a taxpayer. So most of the executives that we work with tend to favor the 457, insured 457F design.
As Corey just described, there are big differences between a traditional 457F plan and an insured 457F plan. Let's take a look at those differences from the nonprofit organization's perspective. From a cost perspective, it's the same amount to your organization. You're putting away the same amount every year on behalf of that key employee. There is a legal agreement between you and the key employee for both traditional and insured 457F. But what about a key person death benefit for the nonprofit in case that executive passes away unexpectedly? Without the insurance, under traditional 457F, there's no death benefit. With the insured, there is. How about for the executive's family? What if the executive passes away prior to retirement? The executive's family is going to has the ability to get a part of that death benefit, not under the traditional 457F arrangement. And how about the tax efficiency in retirement? As Corey mentioned, life insurance cash value has tax deferred characteristics, but securities do not. So from a tax perspective in retirement, the insured 457F can be a much better vehicle for the nonprofit organization, as well as the key executive. Let's talk about it from a key executive perspective. How about the growth? When we have growth in securities portfolios, there are taxes that are paid. But as Corey mentioned, there are no taxes that are paid on the growth of life insurance cash value. It's tax deferred. Same thing when the assets are sold. When the plan is generating income for the key executive, there are taxes that are due as those assets in the securities portfolio are sold, but there are no taxes due when taking distributions via loan or withdrawal from a life insurance policy. Of course, there's not a death benefit associated with securities, but there is associated with life insurance, and it's tax-free to the executive's heirs. We'd mentioned a couple of those frictional costs. With securities portfolios, you have taxes, there are advisor fees, there are fund expenses. And with life insurance policies, there are expenses too, but they're different. There are policy charges and mortality costs. In addition to comparing the two different types of 457F plans, we also need to compare the bonus agreement with a 457F plan. Recall when we discussed bonus agreements a few minutes ago, we talked about incremental vesting. In this example, 20% a year for 5 years until there's full vesting at the end of the 5th year. When it comes to 457F plans, those are typically set up more on a cliff vesting schedule, meaning there's no vesting until the end of year 5 in this example. There are legal agreements that are required for both the bonus agreement and the 457F, but there are certainly differences in taxation. Every year under an executive bonus agreement, there's a tax that's due on the bonus paid to the executive. Compare that to the tax that's due on the 457F plan only at vesting. In addition, there is only a death benefit that's available for the organization and the key executive's family if we use life insurance as a funding vehicle for both the bonus agreement and the 457F. And as Corey mentioned, when it comes to tax efficiency in retirement, the life insurance cash value has tax efficiencies and advantages that traditional securities portfolios don't have. And so we get that tax efficiency in retirement if we use life insurance as the funding vehicle with both the bonus agreement and the 457F. I've talked conceptually about the difference between funding these arrangements with securities versus life insurance. But Corey, why don't you show us some actual examples using real figures of that comparison?
Absolutely. That's, numbers are worth a whole lot of descriptions. So let's take a minute or two to talk about securities versus an insured SERP or 457. So here we've got an example of a 55-year-old male. And the organization has agreed to put in $100,000 a year with a restricted bonus agreement, vesting at 20% per year, or with a 457 vesting in year 5. So we're doing an analytic here, and we're going to assume that the securities and the insurance are increasing at 5.69 after policy charges and after taxes and manager fees. So we've got an apples to apples comparison. The first thing we see is the figures in yellow at vesting. If we've invested in securities, the vesting amount, the taxable amount to the employee is $592,000. If we've put that same $100,000 into an insurance product, the amount vesting is $433,000. So the executive is paying tax on $160,000 less with the insured option. Now you might say, well, yeah, that's because he has $160,000 less dollars. Well, let's fast forward to retirement time, to age 70. The securities account is worth $941,000. The insurance cash account is worth $737,000. Out of each account, we want to net $100,000. With the insurance, we're able to take out $100,000 because the withdrawals are tax-free. With the securities account, we have to take out enough extra to pay the taxes on that distribution each year. So in order to take out and net 100, we have to start with 150. So what you'll see is that at the same internal rate of return, the securities portfolio will not outlast the insurance portfolio. So apples to apples, it's really an internal rate of return decision. So in this example, it was pretty much a no-brainer for the executive. We said, look, you pay less income tax when you vest, and you're going to end up with more tax-free income in retirement. So a much better result for him. So let's take a look at how we did this and how we manipulated this policy design. Our programs are designed specifically to provide institutional designs that do not have, high front-end loads and excessive commissions, but we design the program to take advantage of the circumstance. So here, we wanted to drive down the lower value in the early years so the employee pays less on tax when they vest. So here in option one, we have a far smaller amount that the employee is paying tax on. We did that by making sure that most of the charges occurred in these early years before the employee vested. So the charges were paid pre-tax. Once the employee vests, those charges are a lot less. Whereas if we had spread in option two, if we had spread the charges out equally over the life of the contract, the executive would have paid more in tax and would have had less of a retirement base from which to take withdrawals. So by designing it with most of the charges up front in the first 5 years, we're able to sail into retirement with blue ocean. The client is able to enjoy a much larger tax base from which to take distributions. So we look down further at life expectancy, and by just shifting the charges, we're $200,000 ahead. So number one, we do an IRR analysis to determine whether securities or life insurance should be utilized. Then once we determine that life insurance should be utilized, our proprietary value is that we can help you design the insurance coverage and the insurance contract to take advantage of that executive's tax bracket. Because as we remember, the nonprofit doesn't care. They're just paying out the money. They don't have a tax issue, but the executive does. So when you're planning for your executives, make sure that you explore the options that are going to be most tax efficient for them.
Thanks, Corey. That's great information. It really is interesting to see how just within the life insurance realm, there are different ways to design these policies that are going to be more or less favorable to the key executive. That's a really important point. Speaking of important points, we talked a little bit about split dollar as another way to solve executive retention issues. Corey, why don't you address a little bit about split dollar?
Thanks, David. The split dollar agreements are, as the name implies, there's a division of benefits within this program. And what typically will happen is an organization is paying life insurance premiums on behalf of the executives. And in today's low interest rate environment, typically that's done under what is called the loan regime split dollar. The reason organizations have gravitated towards split dollar arrangements is largely because of this excise tax. It doesn't, if you're making a split dollar loan to a key executive, it's not taxed as compensation up front. It's not even looked at as compensation for purposes of determining the excise tax. So you don't have the same concerns that you have with an overfunded 457F or overfunded other type of compensation program. So under the loan regime split dollar, the organization loans the executive premiums for the insurance policy in today's very low applicable federal rate, or AFR. The executive assigns the policy to an organization as collateral for repaying the premiums, and then the executive takes money from the cash value to supplement retirement income. Organization is either repaid at death or at retirement when the executive retires, separates from service. Perhaps a chart would help explain this because it's a little bit convoluted. So step one, organization makes a loan and a bonus to the executive. Step two, the policy is distributed to the executive, income taxes are paid, and the loan and accrued interest is repaid at death or at separation from service. So the most popular one of these programs that you've probably seen is Jim Harbaugh and the University of Michigan. So University of Michigan, being a nonprofit university, they were concerned about excise tax issues and how do we compensate someone without putting ourselves into a situation where there's going to be an excise tax, which again doesn't look very good on the 990. So you take a look, this was when it happened, in 2016. This was all over the news, ESPN, et cetera. And it really, this article here underscores the importance of what our vision is today. The reason that Jim Harbaugh got this compensation package is because one of the athletic director, who was a former CEO of a big company, said, hey, we have these programs in the for-profit world all the time. Let's bring them to the nonprofit world. And that's our job. David and myself, that's what we do, is we work with nonprofits to show them the best and most current cutting-edge strategies to attract, retain, and reward their people. But this is how the split dollar arrangement got into the nonprofit organizations, someone bringing it from the for-profit world. So let's take a look at how this actually pencils out. So initially, there's a loan made to the executive. That loan accrues interest. If we look at column 5, we see the accrued interest at, this is an older transaction where the AFR was 3%. Today it's like 1.5 or 1.25 for a long-term loan. So that loan balance accrues as the executive ages and stays with the organization. On the other side of the spreadsheet, we see that money being put into an insurance policy, insuring the executive. That benefit is split. There's a death benefit for the organization. There's a death benefit for the employee. So both sides are protected and covered. And during the service, if God forbid the executive were to die, there would be compensation paid out. The loan would be retired via the death benefit, and the heirs of the executive would receive tax-free income, or tax-free death benefit from the program. Should the executive live through retirement, they're able to take tax-free loans from the policy. Here, an example, $143,000 a year. And at the end of the period, the policy is still in force, and the organization gets repaid at death. Now, again, with today's lower AFR rates, an applicable federal rate of 1.25 instead of 3%, that's going to result in a lower loan balance. And so today we're designing these programs to be repaid at separation from service, or at least giving that option so that one doesn't have to be locked in long-term with an employee that's left the organization. So let's take a look at loan regime split dollar versus 457F. For the organization, the loan regime split dollar provides a benefit that will ultimately recover the cost upon employee's death. A 457, when they pay that out, it's just money gone. With loan regime split dollar, they recover their money. They just have to wait until either death or separation from service to do so. With the enactment of the 21% excise tax, loan regime split dollar looks a lot more attractive. Now, again, from the employee's standpoint, the policy loan is not taxable currently and is non-recourse. So unlike Section 457F, where employees got to take that into compensation, the loan regime split dollar is a loan, and it's not taxed to the employee at any time. So a much more favorable result for the employee.
So we've talked about a lot of different kinds of executive benefit plans, but we haven't talked about how to find the money to fund those executive benefit plans. And that can be a challenge for both nonprofit organizations and for-profit businesses as well. But we do have a solution, because in today's interest rate environment, organizations are earning almost nothing on their safest and most liquid capital. Organizations typically keep a portion of their assets safe and liquid. And that's so they can take advantages of opportunities that come along, or in case of an emergency, they have access to cash that isn't subject to market fluctuations and doesn't have any penalties for exit, so they can access it very, very quickly for emergency purposes. The problem is the yields on those assets in today's interest rate environment are low and historically low. But we have a solution. If we can reposition some of those low performing assets into something that's performing better and use that increase as the method to fund that executive benefit plan, now we've got something of interest and really to talk about. So for example, rather than earning, say, less than 1% on assets that are held at the bank or in CDs or in treasury bills, the assets in this specialized life insurance program grow at between 3 and 6% net of all fees and charges. They're 100% liquid, so they can be accessed without surrender charges or without any early termination fees. They also have a life insurance death benefit, which can be used to protect the organization and also be used as a method to attract, reward, and retain key people. And in fact, these programs are so safe that commercial banks have actually regulated that 25% of their tier 1 capital, the safest and most liquid capital on a commercial bank's balance sheet, can be invested in these types of life insurance contracts. So they're very commonly used in the commercial bank space. And now we're seeing them used a lot in the nonprofit space. And here's how it works. So we talked a little bit about the Supplemental Executive Retention Plan policy, the CERT policy, that'll eventually be distributed to the executive upon retirement. But how we fund that CERT policy is that we're going to take out a second life insurance policy, and that life insurance policy is going to be owned by the organization. In this diagram, that's the COLI policy. And we're funding that COLI policy by transferring money from underperforming assets that are in the bank, in CDs, treasury bills, assets like that, and we're transferring those to the COLI policy where they will earn more money. Now that extra money is used to fund the CERT policy, which will eventually be distributed to the executive. Now, typically, there is insurance on the key executive as well in the COLI policy. It doesn't necessarily have to be the same key executive that's being retained for the CERT policy, but somebody does have to have some life insurance on their life. And we typically start with the top of the organization, CEO, CFO, COO, and use their lives as the insuring life on the COLI policy. What does that do? That gives the organization an additional level of key person protection in case that other key executive passes away, right? And it also provides an additional level of retention for that other key executive, because part of that death benefit could be paid to their beneficiaries as well. So let's take a look at the two policies that are being contemplated in this design. The first policy is for the executive. It's the executive's CERP policy. And in this policy, the organization is contributing premiums based on those listed in column 3. Starts off at about $86,000 a year and then increases to $94,000 and so on. By the time the key executive reaches retirement at age 66, she takes the distribution from the CERP and pays income taxes at 50%. It's about a $2.25 million income tax burden. After paying income taxes, the executive now has $186,216 that she can take from the policy without paying tax as an executive retirement benefit. If she happens to pass away, let's at this example pick year 27, age 75. There's $1.6 million of cash surrender value left in the policy, but there's $1.785 million of death benefit. And that's what's paid out to her family when she passes away. So not only does the key executive get this terrific retirement benefit every year upon retirement, but if she happens to pass away during retirement, her heirs will get pretty much the remainder of those income payments paid to them. So how does the organization's corporate-owned life insurance policy perform, and how does that look over time? Well, the organization did have $4 million earning almost nothing in a bank account, and they repositioned that $4 million into the institutional life insurance contract that has much higher yields. Those are listed in column 5. So at the end of the day, the organization has repositioned $4 million from a non-performing asset to a performing asset. In fact, that asset is generating enough income to not only pay the benefit expense, but also to allow the organization to still receive a net yield that's far more competitive than what they're earning in the bank. That's listed in column 10. So the income earned is column 7. The benefit expense to pay the SERP policy for the key employee is in column 8. The net income that remains on the balance sheet of the nonprofit is in column 9, and the net yield is in column 10. So as you can see, this is a very interesting way to find the money in order to pay for the SERP policy without changing the characteristics of the underlying asset. You're just earning more on an asset that's currently not performing well because of interest rates. There is flexibility. If interest rates rise and the organization has a change of heart and wants to move out of this SERP policy, out of this COLI policy and back to an investment account, a bank account, back into a CD, there are no surrender charges or penalties for exit, completely liquid. That's the kind of flexibility and exit strategies we want to make sure that we always have in our plan designs.
Perfect.
Corey, maybe you can summarize a lot of information, Corey, in a short period of time.
Yeah, I'm going to do this as quick as I can because everybody's been with us for quite some time. So let's take a look at what we've learned today. Key takeaways. Okay, there are many ways to attract, retain, and reward your key talent, each with pros and cons depending on the scale of the program and the characteristics of your key people. Life insurance cash value can provide an improved tax efficiency for executives during retirement. So once you decide what type of plan you're going to use, let's look at both the nonprofit and the executive's tax impact when funding that plan. If available, reserves can be repositioned to offset the plan funding costs without sacrificing safety or liquidity. So, key takeaway, we've gone through the summary. David and I both thank you for joining us today. Contact us to request a free report on nonprofit executive retention and to schedule a complimentary consultation. All attendees of the symposium, we offer a 30-minute consultation to talk to you, your key people, and to help you determine if these programs can be of benefit to you and your organization. With that, thank you for joining us today, and we hope you've learned from our attract, retain, and reward best practices in nonprofit executive retention. Thank you, and we'll look forward to seeing you soon.